Hey everyone, welcome back to our channel. Today we're going to talk about something that you may have heard of before in the world of yield farming, and that's impermanent loss. So, what exactly is impermanent loss in yield farming? Essentially, when a token price rises or falls after you deposit it in a liquidity pool. This is known as crypto liquidity pools impermanent loss, IL. Yield farming, in which you lend your tokens to gain rewards, is directly related to impermanent loss. But it's important to note that it's not the same as staking. With staking, investors are required to inject money into the blockchain to validate transactions and blocks to earn staking rewards. With yield farming, you're lending your tokens to a liquidity pool or providing liquidity, and the rewards vary depending on the protocol. Now, while yield farming can be more profitable than just holding your tokens, it also comes with risks. These risks include liquidation, control, and price risks. The number of liquidity providers and tokens in the liquidity pool can also affect the level of impermanent loss risk. Pools with assets like stable coins within a narrow price range will be less vulnerable to temporary losses, making it less risky for liquidity providers. So, you may be wondering why liquidity providers continue to provide liquidity, even though they're vulnerable to future losses. Well, it's because trading fees can compensate for the temporary loss. For example, pools on Uniswap, which are highly susceptible to temporary loss, can still be profitable due to trading fees, 0.3%. Another thing to note is that there's something called impermanent loss protection, ILP. This is a type of insurance that protects liquidity providers from unexpected losses. So, if liquidity providers do suffer losses, they can activate ILP to protect themselves against impermanent loss. Finally, let's talk about how impermanent loss actually happens. In short, it's the difference between the LP token's value and the underlying token's theoretical value if they hadn't been bared. Let's say you have a liquidity provider with 10 ETH that wants to offer liquidity to a 50/50 ETH/USDT pool. They'll need to deposit 10 ETH and 10,000 USDT. And if the pool they commit to has a total asset value of 100,000 USDT, their share will be equivalent to 20%. Now, the percentage of a liquidity provider's participation in a pool is also important because when a liquidity provider commits or deposits their assets to a pool via a smart contract, they will instantly receive the liquidity pool's tokens. And this is where the idea of IL enters the picture. Because liquidity providers are entitled to a share of the pool rather than a direct ownership of the assets, they are susceptible to another layer of risk known as IL. So there you have it, a quick rundown on what impermanent loss is and how it can affect yield farming. As always, be sure to do your own research and understand the risks before getting involved in any kind of yield farming or liquidity provisioning. Thanks for watching.